Welcome to the Expert Accounting channel on YouTube. In this video, we will discuss a lot of essential fundamentals that are important to know for anyone looking for information about accounting. This video is a good introduction for beginners, non-technical professionals, and for anyone interested in the field of accounting. This video offers the perfect high-level survey of the topic. Contents of this video are technical, regulatory, and career-related. Without further delay, let's jump in and see what's in store. Types of costs. Direct costs are those costs that can be directly attributed to a product or product line, one source of sales revenue, or one business unit or business operation. An example of a direct cost would be the cost of tires on a new automobile. Indirect costs are very different and can't be attached to any specific product, unit, or activity. The cost of labor or benefits for an auto manufacturer is certainly a cost, but it can't be attached to anyone's vehicle. Each business has to devise a method of allocating indirect costs to different products, sales revenue sources, business units, etc. Most allocation methods are less than perfect and generally end up being arbitrary to one degree or another. Business managers and accountants should always keep an eye on the allocation methods used for indirect costs and take the cost figures produced by these methods with a grain of salt. Fixed costs are those costs that stay the same over a relatively broad range of sales volume or production output. They're like an albatross around the neck of business, and a company must sell its product at a high enough profit to at least break even. Variable costs can increase and decrease in proportion to changes in sales or production level. Variable costs vary proportionately with changes in production. Relevant costs are nearly future costs incurred, depending on what strategic course a business takes. If an auto manufacturer decides to increase production, but the price of tires goes up, then that cost needs to be considered. Irrelevant costs are those that should be disregarded when deciding on a future course of action. They're costs that could cause you to make a wrong decision. Whereas relevant prices are future costs, irrelevant costs are those costs that were incurred in the past. The money's gone. What are earnings per share? Publicly owned companies must report earnings per share (EPS) below the net income line in their income statements. This is mandated by generally accepted accounting practices (GAAP). The EPS gives investors a means of determining the amount the business earned on its stock share investments. In other words, EPS tells investors how much net income the company earned for each stock share they own. It's calculated by dividing net income by the total number of capital stock shares. It's important to the stockholders who want the business's net income to be communicated to them on a per-share basis, so they can compare it with the market price of their shares. Private businesses don't have to report EPS because stockholders focus more on the business's total net income. Publicly held companies report two EPS figures unless they have what's known as a simple capital structure. Most publicly held companies, though, have complex capital structures and have to say two EPS figures. One is called the basic EPS, the other is called the diluted EPS. Basic EPS is based on the number of outstanding stock shares, weak earnings form of stock options. This is a complicated process. An accountant has to adjust the EPS formula for any number of occurrences or changes in the business. A business might issue additional stock shares during the year and buy back some of its shares. Or it might issue several classes of stock, which will cause net income to be divided into two or more pools, one pool for each class of stock. A merger, acquisition or divestiture will also impact the formula for EPS. Assets and liabilities. Making a profit in a business is derived from several different areas. It can get a little complicated because just as in our personal lives, business is run on credit as well. Many businesses sell their products to their customers on credit. Accountants use an asset account called accounts receivable to record the total amount owed to the business by its customers who haven't paid the balance in full yet. Much of the time, a business hasn't collected its receivables in full by the end of the fiscal year, especially for such credit sales that could be transacted near the end of the accounting period. The accountant records the sales revenue and the cost of goods sold for these sales in the year in which the sales were made and the products delivered to the customer. This is called accrual-based accounting, which records revenue when sales are made and records expenses when they're incurred as well. When sales are made on credit, the accounts receivable asset account is increased. When cash is received from the customer, then the cash account is increased and the accounts receivable account is decreased. The cost of goods sold is one of the major expenses of businesses that sell goods, products or services. Even a service involves expenses. It means exactly what it says, in that it's the cost that a business pays for the products it sells to customers. A business makes its profit by selling its products at prices high enough to cover the cost of producing them, the costs of running the business, the interest on any money they've borrowed and income taxes, with money left over for profit. When the business acquires products, the cost of them goes into what's called an inventory asset account. The cost is deducted from the cash account or added to the accounts payable liability account, depending on whether the business has paid with cash or credit. Profit and loss. It might seem like a no-brainer to define just exactly what profit and loss are. But of course these have definitions like everything else. Profit can be called different things, for a start. It's sometimes called net income or net earnings. Businesses that sell products and services generate profit from the sales of those products or services, and from controlling the attendant costs of running the business. Profit can also be referred to as return on investment, or ROI. While some definitions limit ROI to profit on investments in such securities as stocks or bonds, many companies use this term to refer to short-term and long-term business results. Profit is also sometimes called taxable income. Net worth is determined after all the liabilities are deducted from all the assets, including cash and property. Showing a profit or a positive figure on the balance sheet is of course the aim of every business. It's what our economy and society are built on. It doesn't always work out that way. Economic trends and consumer behaviors change, and it's not always possible to predict these and what income they'll have on a company's performance. Types of costs. Direct costs are those costs that can be directly attributed to a product or product line, or to one source of sales revenue, or one business unit or operation of the business. An example of a direct cost would be the cost of tires on a new automobile. Fixed costs are those costs that stay the same over a relatively broad range of sales volume or production output. They're like an albatross around the neck of business, and a company must sell its product at a high enough profit to at least break even. Variable costs can increase and decrease in proportion to changes in sales or production level. Variable costs vary proportionately with changes in production. Relevant costs are essentially future costs that could be incurred, depending on what strategic course a business takes. If an auto manufacturer decides to increase production, but the cost of tires goes up, then that cost needs to be taken into consideration. Irrelevant costs are those that should be disregarded when deciding on a future course of action. They're costs that could cause you to make a wrong decision. Whereas relevant costs are future costs, irrelevant costs are those costs that were incurred in the past. The money's gone. What is price-earnings ratio? The price-earnings (P/E) ratio is another measurement that's of particular interest to investors in public businesses. The P/E ratio gives you an idea of how much you're paying in the current price for stock shares for each dollar of earning. Earnings prop up the market value of stock shares, not the book value of the stock shares that's reported in the balance sheet. The P/E ratio is a reality check on just how high the current market price is in relation to the underlying profit that the business is earning. Extraordinarily high P/E ratios are justified only when investors think that the company's earnings per share (EPS) has a lot of upside potential in the future. The P/E ratio is calculated dividing the current market price of the stock by the most recent trailing 12 months diluted EPS. Stock share prices bounce around day to day and are subject to big changes on short notice. The current P/E ratio should be compared with the average stock market P/E to gauge whether the business is selling above or below the market average. P/E ratios are currently running high, despite a 4-year slump in the stock market. P/E ratios vary from industry to industry and from year to year. $1 of EPS may command only a $10 market value for a mature business in a no-growth industry, While $1 of EPS in a dynamic business in a growth industry may have a $30 market value per dollar of earnings or net income. To sum up, the price-earnings ratio, or PE ratio, is the current market price of a capital stock divided by its trailing 12 months diluted earnings per share, EPS, or its basic earnings per share, if the business does not report diluted EPS. A low PE may signal an undervalued stock, or a pessimistic forecast by investors. A high PE may reveal an overvalued stock, or might be based on an optimistic forecast by investors. Revenue and receivables. In most businesses, what drives the balance sheet are sales and expenses. In other words, they cause the assets and liabilities in a business. One of the more complicated accounting items are the accounts receivable. As a hypothetical situation, imagine a business that offers all its customers a 30-day credit period, which is fairly common in transactions between businesses, not transactions between a business and individual consumers. An accounts receivable asset shows how much money customers who bought products on credit still owe the business. It's a promise of case that the business will receive. Basically, accounts receivable is the amount of uncollected sales revenue at the end of the accounting period. Cash does not increase until the business actually collects this money from its business customers. However, the amount of money in accounts receivable is included in the total sales revenue for that same period. The business did make the sales, even if it hasn't acquired all the money from the sales yet. Sales revenue, then, isn't equal to the amount of cash that the business accumulated. To get actual cash flow, the accountant must subtract the amount of credit sales not collected from the sales revenue in cash. Then add in the amount of cash that was collected for the credit sales that were made in the preceding reporting period. If the amount of credit sales a business made during the reporting period is greater than what was collected from customers, then the accounts receivable account increased over the period, and the business has to subtract from net income that difference. If the amount they collected during the reporting period is greater than the credit sales made, then the accounts receivable decreased over the reporting period, and the accountant needs to add to net income that difference between the receivables at the beginning of the reporting period and the receivables at the end of the same period. What is acid test ratio and ROA ratio? Investors calculate the acid test ratio, also known as the quick ratio or the Pounce ratio. This ratio excludes inventory and prepaid expenses, which the current ratio includes, and it limits assets to cash and items that the business can quickly convert to cash. This limited category of assets is known as quick or liquid assets. The acid test ratio is calculated by dividing the liquid assets by the total current liabilities. This ratio is also known as the Pounce ratio to emphasize that you're calculating for a worst-case scenario, where the business's creditors could pounce on the business and demand quick payment of the business's liabilities. Short-term creditors do not have the right to demand immediate payment, except in unusual circumstances. This ratio is a conservative way to look at a business's capability to pay its short-term liabilities. One factor that affects the bottom-line profitability of a business is whether it uses debt to its advantage. A business may realize a financial leverage gain, meaning it earns more profit on the money it has borrowed than the interest paid for the use of the borrowed money. A good part of a business's net income for the year may be due to financial leverage. The ROA ratio is determined by dividing the earnings before interest and income tax, EBIT, by the net operating assets. An investor compares the ROA with the interest rate at which the corporation borrowed money. If a business's ROA is 14% and the interest rate on its debt is 8%, the business's net gain on its capital is 6% more than what it's paying in interest. ROA is a useful ratio for interpreting profit performance, aside from determining financial gain or loss. ROA is called a capital utilization test that measures how profit before interest and income tax was earned on the total capital employed by the business. What are other ratios used in financial reporting? The dividend yield ratio tells investors how much cash income they're receiving on their stock investment in a business. This is calculated by dividing the annual cash dividend per share by the current market price of the stock. This can be compared with the interest rate on high-grade debt securities that pay interest, such as treasury bonds and treasury notes, which are the safest. Book value per share is calculated by dividing total owner's equity by the total number of stock shares that are outstanding. While EPS is more important to determine the market value of a stock, book value per share is the measure of the recorded value of the company's assets less its liabilities, the net assets backing up the business's stock shares. It's possible that the market value of a stock could be less than the book value per share. The return on equity (ROE) ratio tells how much profit a BUS8 has earned in comparison to the book value of its stockholders' equity. This ratio is especially useful for privately owned businesses, which have no way of determining the current value of owner's equity. ROE is also calculated for public corporations, but it plays a secondary role to other ratios. ROE is calculated by dividing net income by owner's equity. The current ratio is a measure of a business's short-term solvency, in other words, its ability to pay its liabilities that come due in the near future. This ratio is a rough indicator of whether cash on hand plus the cash to be collected from accounts receivable and from selling inventory will be enough to pay off the liabilities that will come due in the next period. It is calculated by dividing the current assets by the current liabilities. Businesses are expected to maintain a minimum 2:1 current ratio, which means its current assets should be twice its current liabilities. Parts of an income statement, Part 1. The first and most important part of an income statement is the line reporting sales revenue. Businesses need to be consistent from year to year regarding when they record sales. For some business, the timing of recording sales revenue is a major problem, especially when the final acceptance by the customer depends on performance tests or other conditions that have to be satisfied. For example, when does an ad agency report the sales revenue for a campaign it's prepared for its client? When the work is completed and sent to the client for approval? When the client approves it? When the ads appear in the media? Or when the billing is complete? These are issues a company must decide on for reporting sales revenue, and they must be consistent each year, and the timing of reporting should be noted on the financial statement. The next line in an income statement is the cost of goods sold expense. There are three methods of reporting cost of goods sold expense. One is called first in first out, FIFO. Another is the last in last out, LIFO method, and the last is the average cost method. Cost of goods sold expense is a huge item in an income statement, and how it's reported can make a substantial impact on the reported bottom line. Other items in an income statement include inventory write-downs. A business should regularly inspect its inventory carefully to determine any losses due to theft, damage and deterioration, and to apply the lower of cost or market (LCM) method. Bad debts are also an important component of the income statement. Bad debts are those owed to a business by customers who bought on credit, accounts receivable, but are not going to be paid. Again, the timing of when bad debts are reported is crucial. Do you report it before or after any collection efforts are exhausted? Parts of an income statement, Part 2. Of course, profit and cost of goods sold expense are the two most critical components of an income statement, or at least they're what people will look at first. But an income statement is truly the sum of its parts, and they all need to be considered carefully, consistently and in reporting depreciation expense, a business can use a short life method and load most of the expense over the first few years, or a longer life method and spread the expense evenly over the years. Depreciation is a big expense for some businesses, and the method of reporting is especially critical for them. One of the more complex elements of an income statement is the line reporting employee pensions and post-retirement benefits. The GAAP rule on this expense is complex, and several key estimates must be made by the business, such as the expected rate of return on the portfolio of funds set aside for these future obligations. This and other estimates affect the amount of expense recorded. Many products are sold with expressed or implied warranties and guarantees. The business should estimate the cost of these future obligations and record this amount as an expense in the same period that the goods are sold, along with the cost of goods expense. It can't really wait until customers actually return products for repair or replacement, should be forecast as a % of the total product sold. Other operating expenses that are reported in an income statement may also have timing or estimating considerations. Some expenses are also discretionary in nature, which means that how much is spent during the year depends on the discretion of management. Earnings before interest and tax, EBIT, measures the sales revenue less all the expenses above this line. It depends on all the decisions made for recording sales revenue and expenses, and how the accounting methods are implemented. Parts of an income statement, Part 3. Net income is like earnings before interest and tax, EBIT, and can vary considerably depending on which accounting methods are used to report sales revenue and expenses. This is where profit smoothing can come into play to manipulate earnings. Profit smoothing crosses the line from choosing acceptable accounting methods from the list of GAAP and implementing these methods in a reasonable manner into the gray area of earnings management that involves accounting manipulation. It's incumbent on managers and business owners to be involved in the decisions about which accounting methods are used to measure profit and how those methods are actually implemented. A manager can be requiring to answer questions about the company's financial reports on many occasions. It's therefore critical that any officer or manager in a company be thoroughly familiar with how the company's financial statements are prepared. Accounting methods and how they're implemented vary from business to business. A company's methods can fall anywhere on a continuum that's either left or right of center of GOP. Inventory and expenses. Inventory is usually the largest current asset of a business that sells products. If the inventory account is greater at the end of the period than at the start of the reporting period, the amount the business actually paid in cash for that inventory is more than what the business recorded as its cost of goods sold expense. When that occurs, the accountant deducts the inventory increase from net income for determining cash flow from profit. The prepaid expenses asset account works in much the same way as the change in inventory and accounts receivable accounts. However, changes in prepaid expenses are usually much smaller than changes in those other two asset accounts. The beginning balance of prepaid expenses is charged to expense in the current year, but the cash was actually paid out last year. This period, the business pays cash for next period's prepaid expenses, which affects this period's cash flow, but doesn't affect net income until the next period. Simple, right? As a business grows, it needs to increase its prepaid expenses for such things as fire insurance premiums, which have to be paid in advance of the insurance coverage, and its stocks of office supplies. Increases in accounts receivable, inventory and prepaid expenses are the cash flow price a business has to pay for growth. Rarely do you find a business that can increase its sales revenue without increasing these assets. The lagging behind effect of cash flow is the price of business growth. Managers and investors need to understand that increasing sales without increasing accounts receivable isn't a realistic scenario for growth. In the real business world, you generally can't enjoy growth in revenue without incurring additional expenses. Investing and financing. Another portion of the statement of cash flows reports the investment that the company took during the reporting year. New investments are signs of growing or upgrading the production and distribution facilities and capacity of the business. Disposing of long-term assets or divesting itself of a major part of its business can be good or bad news, depending on what's driving those activities. A business generally disposes of some of its fixed assets every year because they reached the end of their useful lives and will not be used any longer. These fixed assets are disposed of or sold or traded in on new fixed assets. The value of a fixed asset at the end of its useful life is called its salvage value. The proceeds from selling fixed assets are reported as a source of cash in the investing activities section of the statement of cash flows. Usually these are very small amounts. Like individuals, companies at times have to finance its acquisitions when its internal cash flow isn't enough to finance business growth. Financing refers to a business raising capital from debt and equity sources, by borrowing money from banks and other sources willing to loan money to the business, and by its owners putting additional money in the business. The term also includes the other side, making payments on debt and returning capital to owners. It includes cash distributions by the business from profit to its owners. Most business borrow money for both short terms and long terms. Most cash flow statements report only the net increase or decrease in short-term debt, not the total amounts borrowed and total payments on the debt. When reporting long-term debt, however, both the total amounts and the repayments on long-term debt during a year are generally reported in the statement of cash flows. These are reported as gross figures, rather than net. What is the FASB? The FASB is one organization that provides standardized guidelines for financial reporting. The mission of the Financial Accounting Standards Board (FASB) is to establish and improve standards of financial accounting and reporting for the guidance and education of the public, including issuers, auditors and users of financial information. Accounting standards are essential to the efficient functioning of the economy because decisions about the allocation of resources rely heavily on credible, concise, transparent and understandable financial information. Financial information about the operations and financial position of individual entities also is used by the public in making various other kinds of decisions. To accomplish its mission, the FASB acts to improve the usefulness of financial reporting by focusing on the primary characteristics of relevance and reliability, and on the qualities of comparability and consistency. Keep standards current to reflect changes in methods of doing business and changes in the economic environment. Consider promptly any significant areas of deficiency in financial reporting that might be improved through the standard-setting process. Promote the international convergence of accounting standards concurrent with improving the quality of financial reporting, and improve the common understanding of the nature and purposes of information contained in financial reports. The FASB develops broad accounting concepts as well as standards for financial reporting. It also provides guidance on implementation of standards. Concepts are useful in guiding the board in establishing standards and in providing a frame of reference or conceptual framework for resolving accounting issues. The framework will help to establish reasonable bounds for judgment in preparing financial information and to increase understanding of and confidence in financial information on the part of users of financial reports. It also will help the public to understand the nature and limitations of information supplied by financial reporting. What is the Sarbanes-Oxley Act? The Sarbanes-Oxley Act of 2002 is a United States federal law passed in response to the recent major corporate and accounting scandals, including those at Enron, Tyco International, and WorldCom, now MCI. These scandals resulted in a decline of public trust in accounting and reporting practices. Named after sponsors Senator Paul Sarbanes, D. Maryland, and Representative Michael G. Oxley, R.O. The act was approved by the House by a vote of 423-3 and by the Senate 99-0. The legislation is wide-ranging and establishes new or enhanced standards for all U.S. public company boards, management, and public accounting firms. The first and most important part of the act establishes a new quasi-public agency, the Public Company Accounting Oversight Board, which is charged with overseeing and disciplining accounting firms in their roles as auditors of public companies. Some of the major provisions of the Sarbanes-Oxley Acts include certification of financial reports by chief executive officers and chief financial officers, auditor independence, including outright bans on certain types of work for audit clients and pre-certification by the company's audit committee of all other non-audit work. requirement that companies listed on stock exchanges have fully independent audit committees that oversee the relationship between the company and its auditor. Significantly longer maximum jail sentences and larger fines for corporate executives who knowingly and willfully misstate financial statements, although maximum sentences are largely irrelevant because judges generally follow the federal sentencing guidelines in setting actual sentences. Employee protections allowing those corporate fraud whistleblowers who file complaints with OSHA within 90 days to win reinstatement, back pay and benefits, compensatory damages, abatement orders, and reasonable attorney fees and costs. Why regulate accounting? Many people wonder why the idea to regulate accounting is becoming so popular. Due to past experiences with manipulating accounting figures, it is no wonder that accounting has been under so much scrutiny. This is the reason why so many people feel it is time to regulate accounting, due to so many companies not abiding by the rules set forth. Because of the many negative incidents that have occurred with different scandals and schemes, there has been a lot of mistrust from the public in the accounting field. To regulate accounting will give confidence back to the public. Here are some of the benefits that will arise when we set higher standards to regulate accounting. A majority of the public feel that accountants are working in the interest of their own company and the companies that they work for, instead of working to inform the public properly. When you regulate accounting, this prohibits any company and accounting firm to hide the truths about the company and its financial status from the public. The regulation of accounting will force companies and their accountants to be more open and straightforward about their financial dealings and show their true financial situation. When you regulate accounting, it will play an important role in the stock market as well. There are many mixed feelings about investing in publicly traded companies because of the capabilities to hide a company's financial distress. If you regulate the accounting laws, then it will lower the chances of a company being able to manipulate any financial report shown to the public, which is a dilemma that has happened in the past. When you regulate the accounting laws, you will hold corporations and public organizations responsible for their actions. This is a very important part in regulating accounting practices. With tougher laws in place to prevent fraud and to prevent special favors, the public will be safer against fraud. To regulate the laws will let not accounting firms and businesses alike aware that they will be held accountable for their actions. Not only will this give confidence back into the accounting field, but it will also deter fraudulent activities in the accounting industry due to the strict consequences. The most important reason to regulate accounting laws is to protect the public. Whether it is a publicly traded company or a company that gains a majority of investments from its workers, both alike need to be protected from fraudulent activities. This is very important and is why the government has leaned to regulate accounting and its laws and practices. It has been proven by past experience to not have strong accounting guidelines in place and enforced only leaves room to lead to a disastrous result. There are many mixed feelings regarding the ideas to regulate accounting. However, despite the mixed opinions, the idea to regulate accounting is strong. It is not only the responsible thing to do, but it will also safeguard the public from companies and fraudulent activities that could occur. To not regulate accounting laws and practices will only leave room to gather more mistrust in the accounting. What does an audit report contain? Most audit reports on financial statements give the business a clean bill of health or a clean opinion. At the other end of the spectrum, the auditor may state that the financial statements are misleading and should not be relied upon. This negative audit report is called an adverse opinion. That's the big stick that auditors carry. They have the power to give a company's financial statements an adverse opinion, and no business wants that. The threat of an adverse opinion almost always motivates a business to give way to the auditor and change its accounting or disclosure in order to avoid getting the kiss of death of an adverse opinion. An adverse audit opinion says that the financial statements of the business are misleading. The SEC does not tolerate adverse opinions by auditors of public businesses. It would suspend trading in a company's stock share if the company received an adverse opinion from its CPA auditor. One modification to an auditor's report is very serious when the CPA firm says that it has substantial doubts about the capability of the business to continue as a going concern. A going concern is a business that has sufficient financial wherewithal and momentum to continue its normal operations into the foreseeable future and would be able to absorb a bad turn of events without having to default on its liabilities. A going concern does not face an imminent financial crisis or any pressing financial emergency. A business could be under some financial distress but overall still be judged a going concern. Unless there is evidence to the contrary, the CPA auditor assumes that the business is a going concern. If an auditor has serious concerns about whether the business is a going concern, these doubts are spelled out in the auditor's report. What are independent auditors? Independent CPA auditors are like referees in the financial reporting arena. The CPA comes in, does an audit of the business's accounting system and methods, and gives a report that is attached to the company's financial statements. Publicly owned businesses are required to have their annual financial reports audited by independent CPA firms, and any privately owned businesses have audits done as well, because they know that an audit report will add credibility to their financial reports. An auditor judges whether the business's accounting methods are in accordance with generally accepted accounting principles, GAAP. Generally everything is in place and the financial report is a reliable document. But at times an auditor will wave a yellow or red flag. Some indicators of potential trouble include when the business's capability to continue normal operations is in doubt because of what are known as financial exigencies, which could mean a low cash balance, unpaid overdue liabilities, or major lawsuits that the business doesn't have the cash to cover. An auditor must exercise professional skepticism, meaning the auditor should challenge the accounting methods and reporting practices of the client in order to make sure that its financial statement conform with accounting standards and are not misleading, in short, that the financial statement are fairly presented. Indeed, the words fairly presented are the exact words used in the auditor's report. A good auditor needs technical know-how, but also needs to know how to be tough on the accounting methods of the client. His job is to be the agent of the shareholders and other users of the business's financial report. It's incumbent on an auditor to strictly uphold GAAP and not let any irregularities slide. There are a number of well-known companies that engaged in accounting fraud recently, and that fraud was not discovered by the CPA auditors. Enron is one of these companies. In this case, the auditing firm, Arthur Andersen, was found guilty of obstruction of justice because it destroyed audit evidence. If you think that starting your own business is cakewalk, you're very wrong. Aside from developing good products and services, you still need to sell them to the market. One of the essential factors in running a business is effectively managing finances. The language of any business, whether big or small, is accounting. The business scene is always loaded with work pressure. Therefore, there is an unerring need for handling accounts and finances effectively. Even small businesses need to be organized to achieve success, and to do this, the business owner should get the appropriate accounting software. Business units usually set long-term goals, and to reach the goals, accounting management is required. If you want to be your business boss, you will need accounting software. Manually doing all the accounting works can lead to a lot of errors which can terribly affect any business. As owner of a small business, you have to know where funds come from and where it goes. If you decide to do accounting tasks manually, it can consume a great portion of your time, and it will be cumbersome on your part. Here are some of the benefits that you will get in using an accounting software. You can finish all the accounting tasks promptly. You will be able to run your small business without too many problems. You can be provided with correct reports as well as special tools to make accounting tasks a lot simpler. That way, you can manage all the financial data of the business effectively. In minutes, you can already manage the cash flow of the business. With the accounting software, it will now be possible to predict revenues, bills, and generating reports. These are some of the benefits of using an accounting software. However, don't purchase the first accounting software that you come across. You see, there are things to consider when selecting the proper accounting software for the business. You have to determine the software's functionalities. It should be user-friendly, and most especially, it should resemble the paper counterparts so that you can run the software smoothly. Once you're familiar with the software's layout, you can already explore its functionalities. If you can find software which combines the internet and e-commerce, the better. You see, there are a great number of accounting software sold in the market. If you want to enjoy all the benefits, you must be able to choose the finest accounting software that is suited to your small business. In choosing an accounting software, you need to consider the number of your employees. You can find accounting software that is suited for small business with less than 25 employees. Other software is suited for large businesses with bigger numbers of employees. A software that is suited for small businesses helps the business owner analyze financial data, customize reports like transaction history, profit and loss, check details, reconciliation details, and many more. By simply looking at the various reports, you can already determine your business status. Some software also offers built-in features like forecasting tools. These tools can be used to manage business risks and control cost of operation. If you're running a small business, it is now time to purchase accounting software. By doing so, you can secure your business future, and you can be certain that all your financial tasks are handled effectively. Why use outsourced accounting? There are many reasons why accounting is being outsourced more commonly by different types of businesses and organizations. Some may think that using outsourced accounting services is a bad idea because of less control and more costs, but that is a myth that has been proven wrong countlessly. In reality, there are greater benefits by outsourcing your accounting services than by organizing your own accounting department or doing your accounting by yourself. We will go over the benefits of outsourced accounting and allow you to see why it is a popular action that many businesses and organizations are taking. Using outsourced accounting services can actually save you money. By outsourcing your accounting needs, you do not need to hire employees in an in-house accounting department. This saves you not only money but also time. It costs time and money to find certified employees to operate your accounting department. With outsourced accounting services, you do not need to worry about salaries, workers' compensation, insurance, or many of the other expenses of having employees. Another great benefit is that you do not have to worry about losing an employee and having to find another in-house accountant to replace the one you lost. There are also many accounting firms that can integrate their services with your own accounting software so that it provides an easy accounting integration. Another great benefit that also comes from outsourcing your accounting needs is that you can focus more on the accounting data. This eliminates having to focus on entering your accounting information and allows you to look at your current situation and make plans for future improvements and developments with the data provided. By being able to maintain your focus solely on payments, invoices and profit and losses, you will be able to spend your time on finding better solutions and maintaining a better relationship with your suppliers and customers. By using outsourced accounting services, you have a lower risk of error and problems with your accounting. It is better to trust your accounting needs with a certified professional rather than trying to do your accounting yourself. Unless you are a certified accountant, you have a very good chance of making an error with your accounting. This chance of error is nearly eliminated when you use an outsourced accounting firm that specializes in the field of accounting. These errors can have a very negative and dramatic effect, not only on your records of what is owed and needs to be paid, but also on your current costs and projections related to your profits and losses. By not properly and accurately maintaining accounting records, you run a high risk of failure with your business. Outsourcing your accounting needs has proven to provide many benefits. These benefits will not only save you time and money, but will also provide solutions to help you grow and expand your business based on the information you receive from your accountant. Accounting can be a very strenuous task that requires a lot of attention to detail as well as knowledge about the field to have it done correctly. Because accounting can be outsourced so easily and can be done at a lower rate outsourced than in-house, outsourced accounting has proven over time to be the best option. Finding an accounting job. Now that you've finished this video introduction, it is time to discuss how to go about getting a job as an accountant. First step is to become certified as a CPA. Becoming a CPA, or Certified Public Accountant, is not a simple feat. There is a lot of education and training, as well as testing, that an accountant must undergo in order to become a CPA. Logically, the first step in becoming a CPA is to have a desire to go into accounting. The next step is to ensure that you have the aptitude to be a CPA. That is, you must have an aptitude for math and numbers, as well as organization. A CPA candidate should also have a good sense of moral values and business ethics. Once you have determined that you are a good candidate for an accounting career, you need to determine if becoming a CPA is the right accounting career for you. To do this, you must understand what a CPA does. A CPA can be employed individually or within a public accounting firm in tax or audit services. A CPA is, of course, a public accountant. That means that the CPA provides services on a fee basis, basically meaning that the CPA works for the public in general, rather than a specific corporation or company. This can translate into variety in your CPA career. Once you have decided that you want to become a CPA, you must attend a college or university to obtain a bachelor's degree in accounting. All states within the United States of America have a board of accountancy or similar department or agency that lays down the requirements for an accountant to become a certified CPA. These requirements will tell you how many credit hours of your education must be in accounting-related courses in order to become a CPA. Once you have completed your degree, the Board of Accountancy will want you to undergo testing to see if you can become a certified CPA. This testing may include ethics examinations as well as examinations to test your knowledge of generally accepted accounting principles, accounting laws, and accounting regulations for your state, as well as tax law and principles. Once you have passed all CPA examinations, some boards of accountancy may require you to provide them with references. These references should be people that can attest to your work ethic and moral character. These aspects of a CPA are very important because CPAs have a lot of opportunity to commit fraud and embezzlement crimes. Therefore, only CPAs who have demonstrated good moral character and a sense of ethics is allowed to receive a CPA license. Once all requirements are met, your state will issue you a license to practice as a CPA. You can then take this license to any firm and apply for a position as a CPA. If you prefer, you could start your own small firm and practice as a CPA alone. For more information about becoming a CPA, you should contact your Board of Accountancy or local college or university today. Once your certification has been completed, you are ready to apply for accounting jobs. A lot of young adults are now wondering where to find the perfect job. They find it very difficult because there are not so many job opportunities out there. But if you only know where to look, you can get a job right away, especially if you meet all the job qualifications. When looking for a job, you should make use of all the available resources like a headhunter or an employment service, the local papers, and of course, the internet. Consider the following tips when searching for an accounting job. First step, log on to the internet. Job sites are all over the web, and so you can definitely find an accounting job there. Most of the sites allow job seekers to sort the job openings through location. After that, you can simply search by using accounting as the keyword. If you surf the net, you can also find websites that focus mainly on accounting jobs. These sites can truly help you in looking for the perfect accounting job. If you can find a job online, then there's no need to check out other resources. If the search for an accounting job online fails, your second step is to check out local papers. Local companies who are in need of accounting graduates will usually post an advertisement in the local paper and not on the internet. This only means that you can also find jobs through the local papers. Take a close look at the classified ad section. Find a section about accounting jobs and there you have it. Sort through the job openings posted on the paper. Get the address of the company and the requirements. All the necessary contact information should be noted. Remember, you will be applying directly to the company and not an employment agency unless stated. Are you still not convinced with the local papers? Your third option is to check with a headhunter or an employment agency. Find a good employment agency that can help you in looking for a job. Some agencies ask for certain fees, while others offer their services for free. Clients pay these agencies to do the interviewing process, so there is a great chance for you to land a job, especially if you're qualified. Make sure that you find a reputable employment agency. So now, have you checked all these resources? Remember to start by surfing the internet, because this is the place where you can find a lot of job opportunities. Then, check out the local papers and eventually, check the employment agencies. Now that you know the 3 valuable resources of job opportunities, all you have to do now is to exert time and effort in looking for specific job employments, and you can already find a career. With a bit of patience, hard work, and dedication, the accounting job that you've dreaming of will soon be a reality. Good luck in finding an accounting job. Make a comprehensive resume so that your application is easily noticed. You see, every year, different colleges and universities produce accounting graduates. You have to be competitive enough so that you can land a job. If you just sit around and wait, nothing will happen. If you want a job, act now.